Hello and welcome to this special edition of State of the Economy. I'm Lata Venkatesh and we are discussing the June consumer price inflation number that has just hit the stands. The number indicates a 2.1%, the lowest since, I think, February of 2019. The inflation of 2.1%, and it is lowest okay, it's not February, it's lowest since January 2019. The fall is sharper than expected by the CNBC-TV18 poll, which threw up a number of 2.3%. Now, the important point is that inflation has been dragged down primarily by food prices. Food inflation would be a misnomer, actually. Food inflation is at a deflation. It is at a 6.5-year low, and as you can see, at minus 1.06. So that's the reason why the inflation number has shocked to the downside. Now, the core inflation number, which is everything other than food and fuel, is called core, largely personal services, which cannot be imported. Medical services, education services, those would come under core, and that has risen by about 4.4%. Now, to discuss these numbers more, we are joined by Rajani Sinha, the chief economist from CareEdge Ratings, Anubhuti Sahay, the head of India Economic Research at Standard Chartered Bank, Narang, the head of Economics Research Group at ICICI Bank. In a bit, we are also going to be joined by Kaustubh Gupta, co-head of Fixed Income at Aditya Birla Sun Life AMC. Ladies and gentlemen, thank you very much indeed for your time. Samir, to you first. This is a shocker, this 2.1%. What is your sense about the future course? Are we going to go below the RBI annual number of 3.7% by a wide margin?
So, Lata, on the RBI trajectory, which is at 3.7, we are at 3.3 for the year, with most of the undershoot happening in Q1, Q2, and Q3. Q1 undershoot is not much. RBI is at 2.9. It's in Q2 and Q3 where the undershoot will be the maximum compared to RBI's trajectory. And you rightly said that it's largely driven by food prices. And within food, it's the vegetable price index, which is driving it, because vegetable prices last year rose by 20%. And this year in Q1, you've looked at a number around 14% decline or deflation that you spoke about. So those are the factors. But within food, there is a lot more broad-based trend that is playing out because of a good monsoon last year and plentiful rainfall this year as well. So cereals, pulses, all of them are showing a decline, and that is expected to continue this year. But unfortunately, too much of a good thing this year will result in a low base. And because of that, led by vegetables, food prices ideally on a low base will be higher next year. So next year, we are pretty much in line with RBI's trajectory of 4.5%. But this year, we are 40 basis points lower than RBI, largely driven by inflation drop up to December. In March quarter, number will be close at 4.5, 4.6.
Okay. Well, Anubhuti, would you agree with what Samir is saying? There are numbers on the street that July is going to be below 2%, considering that, June numbers have come so much below consensus expectations, a good 25 basis point below. Consensus was 2.35. So, it's a 25 basis point lower than consensus. So are we staring at a sub 2%? And what's your annual number?
For monthly inflation prints, Lata, I think it's a very high probability scenario that we'll get at least a couple of prints of below sub 2%. So next month's print, at least based on data published till now, we are seeing a sub 2% number. Probably September might again see a sub 2% number. But I think if we just zoom out and look at the medium-term target of 4%, I think edging above 4% is likely to take some time. It won't come before the first quarter of 2026. And probably there might be some downside surprises there too on a host of factors. One, global commodity prices remain very, very well contained at this point in time. And if we look at the tariff tensions, they are escalating rather than de-escalating at this point in time. Secondly, food prices, as we all know, have been moving lower. Monsoon, we are still in the middle of the season, so I don't want to take too much of a comfort. But all said and done, the reservoir levels, even in the regions where rainfall is deficient, looks absolutely healthy and fine. So there is a possibility that we might see it trending lower. And from MPC's forecast perspective, clearly there is a downside risk. Our forecast is 3.5%. And I think based on today's number, again, let me emphasize, based on today's number and the trend on prices till now, I would say there is a downside risk of at least 30 to 40 basis points even to our annual forecast.
Okay, 30 to 40. So what would your approximate number be, you said?
Our annual forecast is at 3.5%. The tracking number...
There could be a downside.
There could be a downside based on today's print and whatever food prices we are seeing on the ground till date.
So you're looking at 3.3 or 3.4 for the full year?
3.5 with a downside.
No, I mean with a downside.
Yeah, yes.
Okay, before I come to the other economist, Rajani, let me get the bond dealer, the bond expert in. What is shocking about the whole thing, the yields don't seem to have moved much. I would have thought that the yields will at least show some kind of interest and move down. It's standing at 6.3. What are we missing here, Kaustubh? Shouldn't the market be expecting another rate cut?
Clearly, the global headwinds on the bond yields in the developed market is playing on the minds of the market as well. As you know, that for this week we are going to see a lot of data on the US economy side, both on inflation, retail sales, and there are a line of Fed speakers which are planning to give their views for this week, which is why markets are more or less flat. Despite that, on the Friday, US yields jumped from about 7 to 8 basis points. In that context, we are fairly, I would say, stabilized. The second thing on your point is markets. Of course, these numbers are better than market anticipation. But given that RBI has already preempted a lot of rate cuts in its last monetary policy, and the consensus for the market is that probably RBI will wait for a couple of policies to make for the next move. So market for now, they are looking more on what's happening at the global level rather than focusing on local inflation print alone.
Mm-hmm. Okay, got your point that, probably after going from neutral, going from accommodative to neutral just in the June policy, it may be difficult for Reserve Bank to sound accommodative anytime soon and even give a rate cut after you have gone to neutral just in the previous policy. So maybe they will wait and watch. But Rajani Sinha, on that point, do you expect that the Reserve Bank will move because inflation is likely to be, as Samir and Anubhuti are guessing, maybe 3.3, 3.4 this year? Or will they wait for weak growth signs and won't be satisfied with just inflation numbers because, the base effect can take it away next year?
So, Lata, when RBI last time had cut rate by 50 basis points, it was more than expected. And that was mainly on the expectations that inflation is going to moderate further going forward. And that's how inflation data is playing out. So I think RBI had already factored in that inflation is going to go down forward. So now if they cut rates, that will really be dependent on how growth data pans out. So if we look at the growth expectations now, RBI's expectation of around 6.5% for this year, ours is though a little lower at around 6.2%. But I would say around 6.5%, if we go with RBI's projection, that's pretty decent. And that doesn't warrant a rate cut immediately. I think RBI will go for a rate cut only if growth falters further. If the global scenario, I think this window open because if the global scenario worsens, there are too many uncertainties on the global front, specifically with the US trade policy uncertainties. So if we get, some very bad news on that front that hits our growth, in such a scenario, RBI would look at further rate cut. But otherwise, I think with inflation, they had already factored that and hence cut rate by higher than what the market was expecting. So I think they'll cut rate only if growth falters from here.
Well, let me take a quick poll from the four of you. How many of you expect a rate cut in 2025? I'm not asking for just August. Samir?
Well, our base case is no rate cut, but 125 is a possibility. So I would say.
So do I count you as yes or no, yaar? I'm going to count you as a yes. Okay, Anubhuti?
Rate cut, that's our baseline.
Sorry?
No rate cut. That's
No
our
rate cut.
baseline.
Okay. Oh, you guys have this printed report. You can't swerve from your printed report. But I'm guessing that the next printed report is going to say yes for a rate cut. Rajani?
No rate cut if growth is okay. I mean, if it's around this range, 6.2.
I want your poll. We want monosyllabic answers. So no rate cut. Okay. Kaustubh?
We do think that by end of this year, probably there is a window for one more rate cut. So we are in that camp. One more rate cut maybe by December policy.
Okay, so there are two guys. The guys are, kind of leaning towards a possibility of a rate cut, and CARE and Stan Chart have not yet written their report, so they're not going to give us a rate cut vote just yet. Okay, let me look at the growth numbers actually. Samir, look at okay, who was looking at the growth numbers? Rajani. See, the core growth number, 8 sectors, core sector number, came in at a miserable 0.7% for the month of May. For April, it was 1%. And likewise, if you look at the IIP numbers, again, the IIP numbers indicated something like, 2.6 for April and 1.2 for May. You couldn't call this growth. The numbers we are getting in the second quarter, I mean, we've only got IT numbers just yet. We don't have a sizable amount of consumer goods results just yet. But it is looking like, a little under the weather. The Q1 numbers are not expected to be, coming all guns blazing. So do you think that the Reserve Bank has enough disappointment on growth, Rajani?
Compared to last year, or I would say compared to the very good number of 7% plus that we saw in the fourth quarter of FY25, definitely there is going to be moderation in FY26. For the first quarter, we are expecting growth of around 6.4% or so. But I would say while, overall, we are expecting growth to moderate in FY26. Like I said earlier, we are expecting around 6.2% growth. But some points that we have to take into account is that right now there are some good positives for the economy. One, the monsoon has been good, so that is going to be supportive of rural demand. Second, the lower income tax burden that we are going to have for this year. Third, inflation has been going down. And fourth, most importantly, I would say that while on the global front, there are a lot of concerns, but still, at this point in time, things don't look as bad as what we were fearing, say, 2-3 months back. Now, at least there's still not clarity on reciprocal tariff as to what's going to happen on that front. But probably it would turn out better than what was being feared, say, 2-3 months back. So even on the external front, the concerns I would have kind of abated. So overall, I would say that even if the economy records a growth of 6.2% or so, and I think there is probability of now it being higher because our concerns on the global.
Okay, Rajani, let me stop you there and take a quick poll. What are you all expecting by way of growth? Rajani, can you give me your Q1 number and your full year number? And likewise, Anubhuti and Samir. But first, I'll start with you, Rajani. What are you working with for Q1 and for the full year?
Q1, 6.4%. Full year, 6.2%. But like I said, there is an upward bias now because global concerns have somewhat abated.
Okay. Anubhuti?
Yeah, so for full year, we are looking at a growth rate of 6.6% and Q1 at close to closer to 6.8%.
Okay, so that's not really weak growth. Samir?
Well, as per the information available as of now, around 6.3, 6.4 is what you get in Q1, largely driven by spending by the center and the states. As you are, HFIs, you're right, are quite weak as of now. And for the full year, we are around 6.4 because H2, given the stimulus given by the government and RBI, ideally things should pick up in H2.
Okay. So we are looking at an average of about 6.4 if I take all the three of you, which is only a tad lower than what Reserve Bank is working with, 6.5. But it's clearly a downside bias to what Reserve Bank is forecasting. So it could have reasons to rethink its growth number. Quick break. We are coming back with more questions. Welcome back. You're watching a special edition of State of the Economy, and we have been discussing the June CPI numbers, which have come in at 2.1%, far lower than the 2.35, which the CNBC-TV18 poll threw up, a good 25 basis point lower than the CNBC-TV18 poll. The numbers have been dragged down largely by food inflation, which can't even be called inflation. There is a deflation of prices. The CPI has fallen by 1.06% from year-ago levels, and that's largely because of cereals and pulses prices falling and vegetable prices not rising as much as previous June. That's the story of the CPI number. We've been discussing with Rajani Sinha of CARE, Anubhuti Sahay of StanChart, Narang of ICICI Bank, and Kaustubh Gupta of Aditya Birla AMC. Ladies and gentlemen, thank you for your time. Let me come to the inflation numbers and what impact it can have on growth. Samir, would you worry that, when numbers go to deflationary levels, and, the inflation is expected to be like a sub 3% for a better part of 2025, won't that have a negative impact on growth? Manufacturers manufacture with the expectation of a bit of a margin. If that's kind of getting denied, can there be a growth impact?
So, Lata, it will have an impact more on nominal GDP than anything else. The center also was looking at nominal GDP growth upwards of 10%. So it's very likely that you'll have a nominal GDP growth which is around 9% rather than 10% because of very low CPI, and even WPI print was in deflation that we saw earlier in the day. So all of that put together will have more of an implication for nominal GDP. For real GDP, the volume indicators, as you've already pointed out, some of them are turning weak. Though one of the few good things is that rural demand is holding up very well, be it for auto sales, be it for FMCG. And exports to the US are growing in double digits. They were up 21% in the first 2 months of the year. So there are a few bright spots despite whatever challenges that we see. But in aggregate, yes, there are a number of indicators pointing towards even the volume growth being slightly soft. But we do believe that the stimulus given by both the center as well as by RBI will start working through into H2, and that should lead to some pickup in domestic demand as well.
Okay. Well, there are a set of bankers, at least, who believe that, or economists who believe that the fall in cost of credit is not reason enough for people to increase credit growth, to borrow more. You don't borrow more because the interest rate is low. You borrow when you're sure you have a job and you're able to repay the money. And that perhaps may not be a sentiment which is widespread at this point in time. I mean, we remember in the last cycle, up until 2004, credit growth was not picking up. But 2005 onwards, when interest rates started rising, credit growth went to 25 to 30%. So history does not always give you evidence that a fall in rates leads to a rise in credit growth. The more important question, Kaustubh, is how will Reserve Bank behave when it sees this number? Do you think that it may even stay off the VRRRs because growth seems to need more support, or at least inflation is giving them more comfort? Do you expect liquidity policy to be somewhat easier than the already easy policy?
Is that the question to me?
Yes. Yeah, the question to you is, do you expect Reserve Bank to keep liquidity even easier?
So, look, the point is we are living in the world of uncertainty in terms of growth clouds are concerned. And clearly, India doesn't have any fiscal space, and which is why RBI is using its monetary space to support growth. And in that backdrop, they are not only cutting rates, but they are also making sure that the liquidity is accommodative. And which is why we do think that RBI will make sure that liquidity in the system is very, very comfortable. And it remains more than 1% of NDTL for the enabling of a better monetary policy transmission. VRR is just to make sure, VRRR is just to make sure that overnight rates, they don't fall below the RBI policy corridor, so that there is a sanity of RBI policy rates. And despite the VRRRs, as you can see, even in last 15 days, the overnight rates have trended between 5/4 and 5.5, which is where RBI wanted to be. This is the likely to steady state for next 1 year, at least at minimum.
Okay, fair enough. They have definitely kept it way below the 5.5% mark. That is way below the repo rate. Anubhuti, are you expecting any changes in the liquidity policy? Will the Reserve Bank be a little kinder and may not have to do too many VRRs?
I mean, look, on liquidity, I think I would completely agree with what Kaustubh mentioned. RBI has been kinder than what any one of us expected, in terms of announcing 100 basis point CRR cut in H2. VRR, they will have to continue doing to ensure that rate remains anchored to the weighted average call rate, and also to ensure that excess liquidity doesn't lead to any kind of a fraud. I mean, our data analysis shows that whenever liquidity is in excess of, or becomes closer to 2.5 or 3% of NDTL, that can lead to risk of froth bin in certain unproductive sectors. So from that perspective, VRR fine-tuning will continue, but RBI is likely to continue with its liquidity policy of keeping ample liquidity available for flow of credit to the right sectors in the economy.
Okay. Very quickly, Rajani, what are you all expecting in July itself? The dipstick survey I did indicated that you're definitely going to get an inflation below 2%. People were expecting it to fall from 2.35 to about 2.1, 2.2. Now that the June inflation itself is 2.1, there are quite a few people who have told me that they're expecting a sub 2% number. 1.8, I think, was SBI's number. Maybe it's going to be revised lower now after seeing the CPI. What about you? Are you expecting a sub 2 number in July?
Lata, we were expecting around 2%, but given that this number, the June number has come lower than what we were expecting, it's quite possible that in the next month we could get a number lower than 2%.
Okay. Samir, just a final question. What do you expect the governor might say in the August policy? Anything different to expect? Do you expect an easier tone? What would you have him, what would you want to ask him?
So I think, Lata, if you see the tone and the tenor was more about how the inflation trajectory is panning out in March and the next year. If the governor actually also emphasizes on the growth and the inflation outlook for this year, I think that will change people's thinking on where the RBI is heading in terms of its policy making. And on the liquidity bit as well, it's already been talked about. But here as well, what is the extent of liquidity that the RBI would be comfortable at keeping would also be important. Because for every 1 lakh crore of incremental liquidity, the WCACR actually is 3 basis points below the repo. So where they are ideally comfortable with the overall liquidity will give a sense to the markets in terms of pricing the money markets, and the entire yield curve gets priced off that. So I think...
Okay. Also, would you therefore say that the Reserve Bank is likely to stick to this 5/4 as the call rate for a little longer than the market fears?
I think may not be at 5/4, but maybe 5.35, 5.40, somewhere it settles, because the collateralized rates will be slightly, slightly lower. So I think the weighted average would come around the number you're saying. But yeah, pretty much that's where it is settled.
All right, we'll leave it at that. Samir, Kaustubh, Anubhuti and Rajani, thank you very much for joining us in this conversation. The sense we are getting from economists is that the door has certainly opened for another rate cut. It may not come as early as August. Perhaps the Reserve Bank will want to watch the growth numbers, and we will get them on August 31st. The April, May, June GDP numbers will be announced on August 31st. So the Reserve Bank will be in a slightly better position in September, or maybe I think October is the next policy, to cut rates if it wants to. As well, by then you would also know the first round of crop arrivals after the Kharif season. And therefore, maybe October would be in a better position. But it does look that the door opens for at least one more rate cut from the Reserve Bank, and allowing the call rate, the overnight rate, to remain below the repo rate, because the danger from inflation or the danger of prices rising because too much money is chasing fewer goods in the economy is not there at all. We are in a near deflationary situation when it comes to food prices. So that's it on this edition of the State of the Economy. Thank you for watching. More news and updates are lined up for you.